Hello friends, today in cost accounting, I will talk about reconciliation of cost and financial account. This is a presentation which is divided into three parts. This is the part 1. In this part, I will discuss the meaning of profit reconciliation statement, reason for preparing a reconciliation statement, importance of reconciliation statement, reasons for difference in profit as per financial account and cost accounts. Now let us see the meaning of profit reconciliation statement. Profit reconciliation statement is a statement which is prepared to reconcile the difference in net profit as per financial accounts and net profit as per cost accounts for a particular period of time. Here, profit as per financial account means profit or loss as reflected by the P&L account of a company, and profit as per cost account means profit or loss as shown in the cost sheet of the company. Why is it necessary to prepare a profit reconciliation statement? The costing records and financial records of a company are generally maintained separately. It may happen that both set of records show different net profits. In such situation, a statement of reconciliation is prepared to reconcile the difference. Now let us discuss why it is important to prepare a profit reconciliation statement. That is, what is the importance of a profit reconciliation statement? First and the foremost importance is it reveals the reasons for difference in profit or loss as per cost accounts and financial accounts. Secondly, it identifies the expenses and incomes which are not recorded, that is, which are omitted to be recorded in either set of books of accounts. A profit reconciliation statement points out the overabsorption or the underabsorption of overheads in cost accounts. It facilitates internal control by highlighting the variations causing the difference in profits between the two sets of accounts. Another importance is it promotes coordination and cooperation between cost accounts and the financial account department in order to generate correct and reliable accounting data. It also ensures the reliability of cost accounts and checks the arithmetical accuracy of the books of accounts. It enables the formulation of policy regarding overheads. It also helps the management in formulating a policy regarding depreciation and stock valuation. In short, we may say that preparation of a profit reconciliation statement facilitates management decision making. Now let us discuss the reasons. What are the reasons for the difference in profit in cost account and financial account? The first reason being there are certain items which are recorded only in financial accounts. In that, first let us discuss regarding expenses or losses which are recorded only in financial accounts. It includes loss on sale of fixed assets and investment. Whenever there is a sale of fixed assets or investment, the loss incurred on it is recorded in financial account but is not recorded in cost account. Similarly, interest on bank loan or mortgages, discount on issue of shares, debentures, bonds, expenses of share transfer, fines and penalties which are paid are recorded in financial accounts but not recorded in cost accounts. As a result, the profit shown by financial accounts decreases, whereas the profit shown by cost account increases. The second reason is there are certain income or profits which are recorded only in financial accounts, like profit on sale of fixed assets and investment, share transfer fees, rent receivable, interest received on bank deposits, loans, etc., dividends received on investment. All these items are profit or income which are recorded only in financial accounts. But these items are not included in cost accounts. As a result, profit as per financial account increases, whereas profit as per cost accounts decreases. The next is appropriation of profit or loss written off against profit. It should be kept into mind that these details are appropriation of profit and hence they would not affect the profit as per P&L account. But these items are not included in cost sheet and that is why they affect the profit as per cost accounts. Some of the items are income tax, transfer to general reserve, payment of dividend to shareholders, writing of goodwill, writing of preliminary expenses, underwriting commission written off, and so on. These expenses are actually appropriation of profit and hence they will not have an effect on P&L account but they will have an effect on cost account because these are not included in cost account. As a result, the profit shown by cost account would be more than the profit shown by financial accounts. Friends, there are certain items which are considered only in cost accounts. Let us understand each one of them. The first is notional rent of the premises which is owned by the company. When a company is carrying out its business in its own premise, it does not pay rent to itself. However, if the same thing was done in a rented premise, it would have to pay a rent. Considering this possibility, a notional rent or an imaginary rent is included in the cost sheet to come at the correct or accurate cost of production. This is known as notional rent. Such notional rent is recorded in cost account but not in financial account. Similarly, interest on capital employed by the owner but not actually paid is also a notional interest which is included in cost account but not in financial accounts. There are certain assets which are fully depreciated by the financial accounts but they are still in use. So depreciation on such fully depreciated assets are included in cost accounts but they are not included in financial accounts. Salary for the proprietor who gives his time to the business but does not charge the salary to profit and loss account because he actually does not receive the salary is also an imaginary expense or a notional salary which is charged to cost account but not to the financial account. Such notional expenses which are charged to cost accounts reduce the profit of cost accounts and increase the profit of financial accounts. Now let us discuss overheads. In financial account, actual overhead cost incurred is taken into account, whereas in cost account, overheads are charged to cost units on a predetermined rate. It may happen that overheads recovered are different from actual overheads incurred. The difference in amount of overheads if are not charged to costing profit and loss account will have an effect on the profit. And in such circumstances, adjustments becomes necessary. The next reason for difference is different methods of stock valuation. In financial accounts, stock is valued at cost price or market price, whichever is lower. In cost accounts may use LIFO, FIFO, weighted average method for valuation purpose. Similarly, work in progress may be valued at prime cost or work cost. Such difference in method of stock valuation results into difference in profit as per cost account and as per financial account. Another difference is the difference in method of depreciation. Financial accounts may use straight line method or reducing balance method. whereas cost accounts have additional methods like machine hour rate, production unit method, which may be adopted by them. If the method of depreciation adopted by both books of accounts is different, then it would result in different profit as per cost account and as per financial account. Friends, in the part 1, we saw that what is the meaning of profit reconciliation statement. Similarly, we saw that how important it becomes to prepare a profit reconciliation statement. We also saw what are the various reasons which lead to differences in the profit as per both set of books of accounts. In part 2, we will discuss the pro forma of statement of reconciliation and memorandum reconciliation statement and the steps of reconciliation. Thank you.